Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking about how artificial intelligence might impact the investment industry. And my guest is Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. But before we ask the man, let's ask the machine. If you type "how will AI impact the investment industry" into ChatGPT, it instantly spits out a list of how it'll bring down costs while powering up everything from data analysis to algo trading to risk management, portfolio management, quant analysis and more. So AI, a big fan of AI then, but mindful too of wanting to appear unbiased, it also gives a health warning, quote, "AI raises challenges, including ethical considerations, potential biases in algorithms, and the need for regulatory frameworks to address the evolving landscape." Well, Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group, is with me and has been looking at this in some depth. Bob, I know that you believe that AI will level the playing field for the investment industry. Does that mean that the dominance of the bigger players like Charles Schwab, BlackRock, Fidelity, Manulife, will that dominance be undermined?
They're going to have to be wary of a little bit more competition coming in the field. So as you mentioned, definitely the great leveler. And it's funny when you mentioned what ChatGPT's response was, it's probably because it drew off of a report that I wrote or other people wrote, because we're all kind of seeing the same thing right now, which is that capability of AI to do the work, the hard work that a lot of analysts do at some of the larger shops. And that provides them that kind of edge, that competitive edge of having the capability to cover a lot more securities and a lot more regions and a lot more kind of pockets of business. And so therefore that is an inherent edge. But if you can train an engine to do that same kind of analytical coverage, now all of a sudden the smaller shops who may have very talented PMs who just don't have the ability and the breadth of scale to do that same kind of analysis, they can now perhaps cover the same amount of companies and turn over as many rocks as some of the larger firms. So I think what you're going to do is you're going to see a lot more competition. So I wouldn't say the demise of the Fidelities or the BlackRocks, but they're going to have to look around their shoulder.
And who are some of the names out there who are early adopters of AI in the investment industry, and what sort of edge are they getting from doing that?
A lot have been doing it in kind of the unflashy spaces, customer service, et cetera, and kind of dealing with some of the more operational roll up your sleeves type work that investment houses have to do. But Morgan Stanley, for instance, has been in a partnership with Microsoft for a long time. I know they're incorporating AI right now across their wealth advisory platform, so not necessarily investment management. And they're doing it in a way to handle, for instance, customer relationship management, client servicing, things that help the advisor kind of free up and be more available to actually talk to their clients. So you're seeing a lot of that. You have firms like Fidelity who have their labs organization, by the way, which is kind of an incubator and innovator of different types of business concepts. They're doing a ton of work right now. Again, and you'll notice it's kind of back in that same area, customer service, client canvassing and prospecting, helping advisors build out their books. So again, all that kind of roll up your sleeves work. And then there's firms who have to take in lots of non-traditional data. And for this, I would say ESG fund management shops like a Calvert. They're utilizing AI to go out and do all the web scraping to capture those non-traditional kind of data sets to pull into their investment processes. They are kind of looking at companies for their, say, their climate footprint.
And Bob, what are the potential nightmare scenarios here? I mean, computer-generated trading, algo trading has been around a long time and has been seen as a factor in virtually every market crash, going back to even 1987 Black Monday. And of course, now AI also brings new problems of data hallucinations and that sort of thing. What are the pitfalls we're talking about?
Numbers and time are very difficult for these engines to try to discern at this point in time. And we're working on it. I'm actually working on an LLM right now. Same thing. We're trying to figure out how to incorporate the time in. But to your point, it's where can it kind of hit a fork in the road and go wildly off track? And in that regard, if you think about, if you will, the art of corporate financial reporting as it is right now, it takes teams of analysts to kind of reverse engineer a company's financial reports during, say, earnings season, just to kind of undo the accounting, creative accounting tricks that they're pulling in there. How does an engine read and interpret that and look to that going forward and make kind of new iterations of its own cognitive development off of that? That's difficult. And then you think about us irrational human beings, at the end of the day. Who would have thought, for instance, that growth stocks and the Magnificent Seven would be the new safe haven coming into 2023 with all that was going on? But it's the irrationality of us, primarily off the AI hype, that had us kind of flooding into that like in a herd mentality. So these are things that are very hard for an engine to look at and kind of discern and then learn off of. So it's all those curveballs that we as humans, I think, throw at these engines are going to make it hard for them and cause a little bit of hallucination going forward.
Okay. Okay, Bob, it's been fascinating to hear your thoughts. Bob Jenkins, Global Head of Lipper Research at the London Stock Exchange Group. Many thanks for your time today. And that is your look at how AI might impact the investment industry. I'm David Pollard. This is Reuters.